Hi everyone, welcome to this webinar from the Financial Suitability Forum, where today we're doing a MiFID II health check on your business. I'm joined today by the convener of the forum, Paul Resnick. Paul, good to have you with us.
G'day, Craig.
Now, MiFID II started a year ago, but it's fair to say it's almost a regulatory overload that businesses have been going through, and a lot are still struggling to get to where they need to be.
There's an enormous amount to do. As I read both the regulation and the commentaries that are appearing, this is a fundamental set of shifts. Seems inordinately bureaucratic and very different in many ways to things that we've seen before. These are new obligations that are reaching down to the way people think, act, and react to their environment. So that this is very fundamental, very different.
It certainly is. The regulation we've seen up till now has been a lot more aspirational, if we could call it that, where people say, look, here's a standard that we expect you to meet. MiFID does that and the FCA does that, but they go one step further and say, here is the standard that you're going to meet, and here are the key checkpoints that we expect you to pass through on the way to meeting that standard, and that's the new part.
And a lot of those are very personal obligations. There's this real change in the air. There used to be this notion of the corporate veil, and the corporation was the entity that took all of the liability. That's fundamentally shifted. It started perhaps 10, 15 years ago with a discussion about advisors having a fiduciary obligation to their clients and behaving in a manner that was consistent with that. Now it's working its way through to the senior managers of both the advisory businesses and the service and product manufacturers that support advisors. So it's a very individual set of changes working through.
And you're pointing specifically there to the senior manager and certification regimes, which are actually three things tied up in that we're going to be talking about a bit later. But I've just shared up on the screen what we're running through today for our health check for advice givers under MiFID. And the first is the MiFID II suitability rules themselves, or the FCA COBS, I think it's 9.2, describes all of that, and we'll have a look at some of that. From the 1st of January this year, as part of MiFID, there was a new disclosure regime around fees and charges, which is far more comprehensive than we've seen before or in most other jurisdictions. We've got product governance rules, or PROD rules, that apply to product manufacturers, but also to the distributors, who are the advice givers often. And then, as you said, the SM&CR, the senior manager and certification regime, which is where people in the management structure and in the operations area of the business often are going to be held directly liable for not just doing the right thing, but for making sure that if they see the wrong thing being done, put their hand up. So, as I said, all of this is hit in 18 months. You can understand people going, oh my goodness, we're just weary from all this, but it's also almost certainly inevitable that things have fallen through the cracks because there are just so many things.
And of course, the regulator at this stage also has similar challenges, that they're moving the regulation and the enforcement and the emphasis in that enforcement aren't clear yet. So clearly there's a learning experience at both sides. So I'm reading suggestions that there is still a high level of non-achievement of the goals and the obligations in the regulation, but the regulator at this stage is just waving a finger, reminding people that the obligations are there and that they need to face them very rapidly.
There was a news item just in the last week or two of us prior to us recording this, where it spoke of the FCA having gone out and done a review of people's disclosures of the fees and charges and gone, well, we didn't find anything that was prosecutable, but that doesn't mean we're happy. We didn't find anything that particularly made us happy either.
Well, there's a long history of the FCA not being happy, so it probably isn't a news item.
Okay, let's go on to those suitability rules, because the FCA says that they'll be reviewing what's going on this year. They've warned the market of that. And we have some history that we can judge them by, because in the middle of 2018, they did a review around robo-advice. And what they found was there was flaws in the disclosure of fees and sometimes conflicts, I think, but there was certainly problems with suitability as well. So they found failures to evaluate the investment objectives, and we'll talk more about what that means under MiFID shortly, and the experience and the people's capacity for loss. So basically what we're talking about is they failed to know the client, and failures to maintain up-to-date information when giving ongoing services. So that's a particularly interesting critique, that one, because what they're saying is, look, if you're giving advice 12, 18 months out on information that's 12, 18 months old, you're probably getting it wrong.
And of course, when we put this into the international perspective, particularly in the light of news that's emerged out of Australia over the last 18 months, where we've had a Royal Commission looking at institutional advice predominantly, and finding that the nexus between the fees being charged and advice being given was very poorly constructed. You see in the UK regulation, but in Australia, the threat of criminal sanctions and criminal action against executives and senior managers who were unable over the last 3 or 4 years, despite warnings from the regulator that they were concerned about issues like ongoing fees not being tightly tied to particular services, that those links weren't there. We're talking about $1 billion worth of fines being threatened at the moment, and a number of senior managers, directors, general managers, CEOs, and chairmen now looking for new ways to fill their days.
Let's move down through the suitability rules, because one of the things that we know is when the FCA comes knocking, they're going to say, look, we gave you a fairly prescriptive set of rules. Let's see how you went following them. So this is what they say regarding suitability, that a firm must take reasonable steps to ensure that a personal recommendation or a decision to trade, or I might add, a decision to do nothing at all, is suitable for its client. So that means they must obtain necessary information regarding their knowledge and experience in the investment field, their financial situation and their investment objectives. And that doesn't sound like it captures enough, but it comes down to the way that they define things. So understanding their investment objectives, that captures the proposed duration of the investment, their preferences for risk taking, their risk profile, and the purposes of the investment. So that's not necessarily the heading would always see those items under, but those items are the ones that would be expecting to see in that process. It's within the client's capacity to bear loss given their circumstances, their income now, their assets, their investments in property, their financial commitments now and into the future, and is within the client's knowledge and experience of the financial risks involved. That means that firms must have information about the client's knowledge, and they must have a level of education of the client which is or perhaps isn't relevant to how much they're capable of understanding a financial thing. Well, this is an area that I have a little trouble grasping. Are they trying to say that someone can't be sold a product that they've never had before, or they can, provided you educate them to the level where they can understand it properly, so they have the knowledge required? Because balancing knowledge and experience, they're two quite different things.
This is a great challenge. We know from general experience and from research that people struggle with general literacy and financial literacy and numeracy, and to balance off the amount of information we give them, we're obliged to give them, against their ability to assess, compare, contrast, work through trade-offs and make decisions, seems a particularly inhuman demand on somebody who simply just wants to invest their pension or or something towards the meeting a future financial goal. Nevertheless, it's there. I think what this demands is a huge change in approach that the advisor must take on, and the people and the services the advisor brings into play. If we assume the world is infinitely more complex because of this much broader contextual demand in the regulation to make whatever decision is made relevant to the client's overall circumstances, then we've got to have advisors who are good at asking open-ended questions and helping people prioritize their goals, even if they had no notion when they came in to the planning process that that's what they were going to be asked to do. So we're on a very long pathway to better and informed advice and informed consent, with great challenges for all parties, advisors and clients. This is the movement from product sales to advice, promotion, trade-offs, getting into the minds of clients, helping them articulate their values, prioritize them, put monetary values against them, and then discover that their partners in life have an entirely different set of values. It takes us into goals-based planning and life coaching. The regulator is asking every advisor to look at this and take it seriously.
And we might just recap our house view here at the forum, if you like, that there are 5 basic elements to suitability. The first is to know your client, which includes their risk profile, their goals and objectives, as you said, their current circumstances. The second is to know the product in great detail as to its, if you like, potential risk outcomes, how much volatility could be inherent in that product. And we must include, I suppose, a model portfolio under that banner of a product, because they're becoming increasingly common. And the third step is to have a logic and a rationale for bringing the two together, for saying, on this day, this product was suitable for this client for these reasons. Then we have the process of the client signing on to that, which we call obtaining informed consent, and then monitoring and maintaining suitability, which is what the FCA was pointing to in our discussion a few moments ago when they said, hey, 12, 18 months out, if you're going to be reviewing an arrangement, make sure that you review it properly and say, well, look, what has changed with you? In that time, any number of things could have changed for a person. They may now be caring for an aged relative, whereas 12 months ago they weren't.
And that's our great challenge. So informed consent is the focal point. To be able to get an informed decision and not simplify the product and simplify the choices is going to be very difficult. So this is a huge demand on advisors. We're already seeing it play its way through. You talk about model portfolios. In the UK, the language that's used is that there are things called discretionary funds management, DFMs, which provide multi-asset solutions. And over the last 5 years, they've become increasingly popular as they're much easier to explain and much easier to prove that there are all of the appropriate risk management techniques have been applied. It's much harder for an advisor to be able to see whether they've got 2 equity funds. One might be selling an asset, a particular company, while another one's buying it. Not necessarily particularly efficient for the client. So this movement to simplifying products that can be explained and making the understanding of client much more comprehensive are the prevailing trends.
Now, I'm just going to bring up this disclosure slide on screen, because as we mentioned earlier, from the 1st of January 2019, new rules applied in the UK regarding disclosure around the costs and charges that attach to financial products and services. And they're different to rules that we've seen before. The big headline, I guess, is that you have to disclose all fees, and we'll go in a moment into what all fees are, but you have to disclose them both as a cash amount in pounds, this is how much it will be for the year, but also as a percentage amount of the assets under management. Now, Paul, we know from our experience around the world, clients get a little bit toey when it comes to fees, and highlighting the fee like that so boldly in front of them is going to lead to some tough conversations in some planners' offices around the country.
Well, this is, I guess, a continuity of the FCA's enthusiasm to match services against fees. I think everybody's going to have to be able to say, well, I charge you £5,000 a year, and this is the value I bring to you. If you were an English advisor and you would move to Australia, what you'll find yourself having to recontract on an annual basis and get the client's buy-in to the next 12 months fees. So in Australia, the link between ongoing fees and services has been so poor that the regulator has enforced, or is about to enforce, recontracting every 12 months. In the UK, that's not there yet.
I do think the regulator is going to be all over these disclosure rules like a seagull on a chip, though, because it's the sort of thing where people are going to get it wrong. It's such a big change to what they've done in the past, and it's so all-encompassing, and some of the areas are not necessarily what you'd expect to see. So in services, it covers initial advice fees, ongoing advice fees, and management fees, and that's any management fee to any one. Third-party DFM costs, platform fees, broker commissions, transaction taxes, research or custody costs, performance fees, and then in investments, any front-loading of management fees, any other management fees charged by a fund manager or service costs, anything masquerading as a fee, any broker commissions, entry and exit charges. I have seen a few people commenting in the press that this is too much, that these are advisors saying, look, this is far beyond what's required, but nonetheless, it is what's required.
It's clear that there are an inexorable number of fees. I think that the great challenge is to communicate the consequence. I think we're seeing some of that with this shift from active to passive investing to buy and hold rather than trade, both of which reduce the fees. The intriguing offer that the markets provide to clients is the benefit of what looks like the prevailing equity risk premium. A simple definition, it is the return equities will give you over inflation over the longer term. Now, when I look at the UK experience over the last 50 years, in a typical 60-40 equity bond cash portfolio, that's been round about 6% per annum on average over the last 48, 49 years. Now, if you end up taking 2 or 3% for fees off that, the aggregation of all of those individual costs, plus the friction caused by taxes if you're actually crystallizing gains in a taxed environment, and that comes to 2 or 3%, that's half of the equity risk premium. That changes the game. So the visibility, the obligation for this to be disclosed, and then for it to be openly discussed. And I think what we'll see is the financial media and the public media will be looking at and talking about these issues very publicly over the next 5 or 10 years. It's going to be very difficult to escape and hide behind the argument that clients won't understand we've disclosed, but we won't explain. Won't be a good enough defence.
And we've seen a problem in Australia over the last few decades where it was very easy to bamboozle a client and deceive them into thinking they were paying a lower fee than they were, because the advisor's fee might have only been 80 basis points, 100 basis points, but they just didn't see that the platform was then taking another 100, and the office cleaner took 20 for some reason that was not apparent, and everybody had their hand in the pocket as it came on by.
Craig, your cynicism is shining through. There was reasonable disclosure here in Australia, and it probably wasn't anything like the UK. I think that the big thing to note in Australia is that while we had regulation, we had virtually no enforcement, and therefore there was very little fear of being caught out, and that hasn't been what's occurred in the UK to the same degree.
Yes, the Australian regulator who would say stop, and if you don't stop, you'll force me to say stop again, and maybe one more time.
Yes, we've certainly seen in the last few weeks, for any of our listeners and viewers, the having been poked by the Royal Commissioner to be more active. Our regulator seems to be getting up every day, looking in the mirror and saying very loudly, I'm going to sue the arse off somebody today. There is a huge fear now that the pendulum has gone from being, I think the technical term was regulatory capture. The regulator was caught up in the big end of town and unable to express their obligations to enforce the regulation, to the other extreme that you just need to breathe out of place and you'll be slapped.
Now, here's the best segue that I'll do for you today to bring us back to the UK. Australia may soon have, in common with the UK, product governance rules, because currently before the Australian Parliament there is a set of product governance laws that are basically modelled on the UK, where again we think this is one of those areas where it's such a new requirement and there's so much complexity hidden down in the detail of it that people aren't going to be necessarily getting it right. So let me run through PROD for anyone who needs a prodding and a reminder of what it is. Under product governance, firms that issue and distribute, because the obligation is on both sides of the transaction, firms must ensure that the products meet the needs of one or more identifiable target markets. They must define unsuitable markets where that product can't or shouldn't be sold without good reason. It doesn't mean that it can't be sold there. They must ensure that the products are sold to clients in the target market through appropriate distribution channels. And they must ensure that those products deliver appropriate client outcomes. Now, we're going to go through shortly what that means for distributors and what that means for the product manufacturers themselves, because there's different obligations at each level. But as a general set of obligations, Paul, you just have to say, wow.
I concur, wow. What we used to have is a serial set of liabilities. You had the client, you had the advisor, and behind the advisor was the product manufacturers and the platforms and service providers. We talked about a fiduciary obligation. Sometimes it was converted to best interest in some countries, and it was rarely enforced as fiduciary except by self-regulation of a small minority of advisors. Called themselves fiduciary and worked on that basis. So rather than emphasising and changing advisors' liability to behave in a more fiduciary manner, or to complement that, we're now bringing to account the other people in the service and supply chain, the manufacturers and their senior managers, and saying, you too are responsible for suitability. Now, you do this against a background of disintermediation of your relationships with end clients over the last 20 years, and you now have to reverse that. You have to be able to find ways of knowing the client and communicating with them, or at least being communicated by them back to you. So this is another fundamental change. It doesn't exist with anything like the level of detail in any other country other than Australia as we can find it. For those of you contemplating a trip to Europe and been caught up with Brexit, I can tell you I've been both to Germany and Brussels and Holland over the last short while, and there's a high level of indifference to these sorts of obligations, and even MiFID II in the European marketplace. There's no fear that the regulator will enforce anything because, as many people say, the regulators in Europe don't know what they're doing. This isn't going to be something that is going to be active. So whilst the UK and Europe are both following MiFID II's broad set of obligations and some of the extensions that go through issues like PROD, there's nothing like the same rigor being applied in Europe. That this is really quite a game changer to say to fund managers, you have to do the same job as the advisor.
And you often describe it as a shift from, in the old days when it was a disclosure-based regime where you just dumped data on people and that was supposed to equate to them understanding. That was a buyer beware environment. Now we're in a seller beware environment. I
think that's a good issue. Every seller has a set of obligations, and we have an activist regulator, if we use the American term. This is not a black letter regulator in terms of legal practice. The seller has been warned, and if I can use as an example that's emerged in Australia, the fee for service obligations, the fees were collected for a long period of time, and the regulator in Australia has been saying, as has the FCA, and before that even the FSA, that you need to get your act into order and make sure that you're providing the service. Over the last while, it's emerged that the Australian regulator had been saying the same thing to Australian enterprises who had largely ignored the warnings. And even over the last couple of weeks, the penalties for charging without any obvious fee, any obvious service, have now reached $1 billion of compensation before we get to the actual penalties. And we're seeing the defence coming out of enterprises that they can't get their systems into place for another 2 years. And the regulator is saying that just isn't good enough. You can't just say it's a problem in my systems. You actually have to go and fix it.
So when we look down the obligations on product issuers, they must ensure that the product is designed to meet the needs of an identified market and has an excluded market that shouldn't necessarily be buying it. They have to ensure that the strategy for distribution is compatible with that identified market. And they have to take reasonable steps to ensure that the product is distributed to mainly that market. There are some exceptions. You can sell a product into the market that is specifically meant to be excluded from it, provided that you have a good basis for doing it. And if you do too much of it, the FCA will come looking. It's a reportable thing that has to be reported back, the percentage of your sales that fall into that excluded sector. So that's designed to catch people who would try to rort their way around it. But when you look at that set of obligations, here in Australia, when law firms that advise big financial institutions saw very similar rules, they wrote back to the government considering the legislation and went, this seems to put the product issuer on the hook for the people all the way down the chain, which is what used to be the case here in the 60s or 70s, and we worked our way out of that, but you'll be delivering that back to us. So that this must raise some doubt about, well, how much does a product issuer have to do to have their hands cleaned if something goes wrong with the distributor who's lying to the issuer or is just acting a bit rogue. So there's a lot of grey comes in between the black and white here.
One of the things that comes to mind, Craig, of course, is that in the UK, when the FCA at the time, sorry, the FSA at the time, announced the first round of suitability obligations and penalties emerged in 2011. Most of the major financial institutions closed down their planning businesses over the next 6 months. Ironically, they're now re-looking at that. Something similar has happened in Australia. In the light of the Royal Commission, most of our major financial institutions are either in the process of selling their planning, life insurance platform, asset management businesses, and going back to their core banking competency and leaving planning to a more independent marketplace. So we are seeing a parallel, I think, in between the UK and Australia in that matter.
So if we hop over to the advisor's obligations under PROD, as a distributor, they must understand the financial product they distribute. And you go, well, yeah, I understand the product, but there's quite specific requirements about what understanding means. And I can tell most people now that it means a deeper reading of the product and its potential risk outcomes than you might be accustomed to. You have to assess the compatibility of the financial products with the needs of the clients and ensure that they're only distributed when it's in the best interest of the client. Now, none of this is impossible and none of it is even necessarily difficult, but it all has to be provided for within the system and the process. And I think, Paul, that's where people are going to come unstuck, that they won't necessarily have the system and process in place. For example, that if you sit down once and define your client categories that are going to be used as you go through different types of transactions, it's probably done for a considerable amount of time then. But if you don't do that, that's where you're going to get caught, because you're going to be trying to do it ad hoc as you go.
Well, I think what we're seeing is that we used to give clients complicated portfolios, having done very little to understand the client themselves. And now it's reversed. We now have a much greater obligation to understand the client. And the easiest way to meet the client's needs and meet these obligations is to actually simplify the product and make them more predictable. So the classic way of doing that is to create a suite, a portfolio suite, with relatively tight benchmarks for discretion by the manager. So it may be you may say there are going to be 4 portfolios in this suite. They're going to have 30, 50 and 70 and 90 equity exposure, plus or minus 7% either side of that, or 10%, so that the advisor and client can predict with greater certainty both the return and the volatility. Now, we see those have emerged already over the last 6 or 7 years, and from the data I'm reading, a large number of UK advisors have already taken on versions of this. DFMs is the collective term that is sometimes used. And we can see it can be done with active managers, passive managers, fund of funds, using alternatives, using property in the portfolios. We've seen many of these options being created, but they are essentially predictable. They may not deliver alpha, but they will deliver predictable outcomes that will be consistent with people's tolerance for risk, amongst others.
Now, it's funny that you bring up alpha, because we need to talk about alpha and alpha males. You and I both remember a time when just about every financial advisor that you would meet was a male, and 95% of them would boast to you that their role in life was to be the stock picker above all other stock pickers, or the fund picker above all other fund pickers. And that simply isn't the case anymore. And you've basically opened the door to it there, where there's going to be a number of portfolio solutions that sit on the shelf for different types of people and circumstances. And this might be quite a diversified number, but they're quantified. They're not a bespoke construction every time a new person comes in. And the art of financial advice is being able to listen to people, to have some empathy of their circumstance and the fact that their objectives are hopelessly conflicted. They want two different outcomes from the same pot of money, and it's never going to work for them. To work through that, have them go through the trade-offs that are required to achieve the objectives that are most important to them, and rank the others second behind it, to understand how they're going to explain to them and talk them through the risks that they'll be taking on and what that will mean for them. And these are, in the past, they've been referred to as soft skills, but listening and talking skills are more female skills than alpha male skills. And we have seen a small shift towards more women entering financial advice, but you and I have spoken about this many times before, Paul. There must be a flood coming, because when you start working around goals-based and people needing to show empathy and have deep, meaningful conversations with people, the bottoms you start putting on chairs are attached to women rather than men in many cases.
And we can see that. I'm involved in some research and some activity in this in other parts of the world. The major challenge is a compensation challenge that makes it difficult for women to, at its broadest level, give advice. But one of the intriguing parts of the regulation around the world is that it's largely product-centric, whereas what we're talking about is helping people understand their circumstances, understand their personal drivers, their values, prioritizing them, putting a numerical value, mapping that, helping them achieve their goals. That's not a licensable activity in many countries. Now, it's contentious, I think, in the UK. The regulator is pushing people to be regulated for it. But in Australia and in other countries, that's called financial coaching or life coaching. That doesn't have all of the inordinate costs, insurances, capital, technology requirements. So this movement to collaboration, which is more empathetic to, if we were to generalize to a woman's perspective, might well be enforced by or encouraged by a regulatory environment which makes it much easier. And we might well see the development of financial planning on an hourly basis, particularly by women who want to do things part-time, don't want to set up a business, don't have the capital to do it, but could be happy helping people prioritize their lives and work towards achieving those goals. Financial advice is 98% behavior and 2% the markets.
Yeah, but as you say, traditionally, all the regulation has tied to the sale of that product rather than, and that's why that's called soft skills that go around it. The financial transaction was the hard skill, if you like, and everything else was considered soft. So let's go back to that fourth element now, which is the senior manager and certification regimes. And they're actually two different things. There's the senior managers, and then there's the certification, and they're two different regimes, but three things fall underneath it. First, there's the conduct rules, which require, and you'd think this would be stating the obvious perhaps, but all staff must act with integrity, care, and in the interest of customers, and in cooperation with regulators, and be trained specifically in these matters. that in cooperation with regulators is interesting. If the FCA comes knocking on the door and says, what do you know about this? And you say nothing, and they later find out that you knew something, you are in deep, deep trouble under these rules. So the senior managers regime, senior staff must be approved by the FCA and meet fitness and proprietary standards. So that's quite a formal process. You have to nominate people to the FCA and say, look, I want Bob Smith to carry this role. And Bob Smith is then either approved or disapproved by the FCA. So it's a very formal approval. The certified persons regime is different. That's an in-house process where you have to go through a fit and proper internal assessment for all the non-senior people that are involved in advice. And the FCA has clarified around this that people who aren't involved in areas that have a financial aspect to them, and so people whose fingers never touch the running of the money, aren't captured by this. So the person who comes by and empties your waste bin each night at your desk is not covered by this. The person who runs the IT helpline is not covered by this. But your paraplanner or your person who assists with it, anything that touches a client or faces a client, anybody whose fingers fall on that probably is caught under this. So the conduct rules: act with integrity, due care, diligence, be open and cooperative, pay due regards to the interests of the customers and treat them fairly, observe proper standards of market conduct. Paul, you'd have to say bravo.
You have to say it's a very comprehensive and somewhat intimidating list. When I look at this, I'm very conscious that I'm reaching the end of my career, and my aspirations to become a financial planner in the UK are at a very low ebb. These are really very, very high standards of expectation. It will be intriguing to see how the regulator in turn enforces them.
Now, if we go to the senior manager regime, that's the one I was saying that you have to nominate. Bob Smith will be in this role and these will be his responsibilities. It's actually described in the rules as a duty of responsibility to the FCA, which is... This
is curious, isn't it? It goes back to, or reminds me of an obligation that the actuaries in life insurance companies used to have, which was that they were not only responsible to the CEO of the business and the directors, that they also had an overarching responsibility to leave a larger estate to the next batch of actuaries that were to take over the business. And this has a similar overarching overlay, if I'm not misusing the terms, that you have somebody outside the corporate line of responsibility that you're obliged to. It's going to be very interesting to see how it works its way through.
Well, it also seems to create a line of enforcement where the FCA doesn't need permission from anybody. It can take enforcement action if it believes that the firm has contravened a relevant requirement, and there's quite a few of them, that the senior manager had responsibility for that activity and the senior manager did not take the steps to stop it. And that's something that runs throughout these rules, is that people are not just expected to do the right thing. They're expected to put their hand up if they see somebody in their firm doing the wrong thing.
And it extends to knowing, because here is a sort of peer group review, isn't there? There's an obligation to be doing no worse than everybody else. And that demands a degree of openness that many firms may find difficult. But if you look at the words that as be reasonably expected to do, requires you to understand what others are doing. So I suspect this is going to result in a greater degree of openness and capacity to communicate what managers in different firms are doing. It's going to change some of the silo effects of business considerably.
And it's a big thing to get ready for, because you have to have statements of responsibilities that name each person that has any one of a long list of identifiable roles that the FCA puts forward from CEO down, that must be identified, and that must name the person and what they're accountable for. Basically what the finger can be pointed at them for when it goes wrong. And then all of those statements have to be combined into a responsibility map that covers the entire organization and anything that could possibly go wrong with running the money anywhere. And if the FCA comes along and says, here's a gap in your map, you're in trouble.
It's somewhat intimidating, isn't it? It is suggesting that the small advisory business will be under some pressure. And once again, I suspect simplification at the product end is going to be one of the big plays. If we say knowing the client and knowing the product, the two of our 5 suitability proofs, we're going to use lots of technology to help us improve our understanding of clients and clients' needs, to be able to collect the data and help us interpret it. And the simpler the product, the less variable its outcomes, the easier it will be to navigate these obligations.
Now, the certification regime is a separate thing to the senior managers. Under certification, you don't have to get these people approved by the FCA. It's an internal process, but that doesn't mean that it's a walk in the park. They still expect you to do some fairly decent checking. Quaintly, a physical certificate must be issued. You can't just have a computer file somewhere. There must be a certificate that can be hung on the desk next, or hung on the cubicle next to the desk. And it must state that the person is fit and proper to be certified, and the aspects of the business that they're going to be involved in. So let's use your sister, Mary. Mary Smith is certified to carry out this role in terms of dealing with a client. And prior to hiring them, you must certify them at that stage, including criminal reference checks, criminal records checks, and what they call a regulatory reference. And a regulatory reference is a ripper idea, I reckon. You've got to go back through past employers and say, excuse me, did you sack Mary Smith at any point for doing the wrong thing? Surprisingly, up until now, that's really not been a requirement anywhere. And
it has to be at the risk of serious contravention of privacy. I'm not sure that would work in Australia from my experience, but it is. If one stands back, it's basically saying we don't trust you.
And I think the US does have something very similar to this. I recall a story about the SEC maintaining a record on people that was a very arcane thing like this, like a certification process. But if you were a financial advisor or anybody who worked around money, and somebody put in one of these records that had a cross in the box instead of a tick, you didn't work again. It was a really, really prohibitive thing. But this is not what's applying here with the FCA. So the sort of functions that we're talking about here are significant management functions, anything that's client facing or client touching. I think even if you just greet them at the door, because people can say stuff. Clients say, oh, I'm hoping that I'll get a really good result today, and somebody says something that's inopportune. So suddenly they're involved in the thing. The supervisor of any certified function, material risk takers, algorithmic traders, a few other more obscure things that were tied up in there. But when you look at that, Paul, with the senior managers, basically everyone on the business that gets anywhere near a piece of client money is going to be on the hook.
Yes.
They do something wrong.
And huge level of responsibility, both to themselves, their family, their employer, their clients. It feels like an overreach, doesn't it? It's almost, you're guilty unless you can prove your innocence. And I could well understand people being dismayed by these sets of obligations, that they seem extreme. Nevertheless, they're there, and that the threat is, while not immediate, is soon if you don't pay attention to them. Things that are similar to what's occurred in Australia, where the presumption was that the regulator wouldn't enforce, were found to be flawed. Wasn't a good assumption.
And what I see running through this, particularly when we bring all four sets of regulations that we've been talking about today together, what I see running through it is a regulator who's preparing themselves that when the time comes to throw the book at somebody, it's going to be a big, heavy book. It's going to be a war and peace type book, not just a little pamphlet. And so that has been a problem in a number of jurisdictions around the world where we've had people who have gone rogue, who've just done terrible, terrible things. And the regulator hasn't had enough of the right powers at the right time to be able to take them out. And part of what we haven't talked about today, but is also tied up in this, is that the FCA gets tough new stop rules. So whereas before they've had to go to a court and argue we need to stop somebody promoting this product because it's harmful to people, now they have the power to just stop it.
Yes, and that's going to result in a much, how can I put it, a safer world, perhaps. Less risk will be taken, less rewards will be delivered, it'll become more bureaucratic. And I'm left, I have this resonating line in my head now that says, we get the regulation we deserve, we get the politicians we deserve. And I don't know quite what advisors in the UK did to deserve such a level of supervision, but one can only hope that those that have remained in the industry are going to be able to navigate it well. Otherwise, the shortage of advisors in the UK will get much greater.
So my last slide for today is how people are doing on all four of these things, on the suitability, the disclosure, the senior managers. I don't know that there's going to be people who will be able to tick the happy face box for every single one of those. From what we hear and from what we read in the trade press and in the media around financial advice, these are causing some real headaches in firms out there as to how they implement it and how they make it work on a day-to-day basis.
I think that's right. We still have to make a living as well as take on board all of these obligations. So I suspect of the four sets, if we have one smiley face, we're doing well.
And as we've been talking through this webinar, you've sort of skated around the edge of it a number of times, but let's just address it specifically before we go. A lot of what this is requiring is some conformity to a process where previously people might have been able to be a little bit more spontaneous, a little bit more free range. This is putting walls around how you go about giving advice, how the elements that feed into that. It's making everything more structured than we've seen it in the past.
Much more prescriptive, yes. I remember conversations with advisors who would talk to me about the art of financial planning, and it's I think we could say it may remain an art, but it is within a relatively tightly defined set of new obligations to be worked through, and I can pick up nothing to suggest that there's going to be any change of direction. Pre or post Brexit, for instance, to get to a profession, we've been given the chance of doing it ourselves. We were unable to do so, and now a regulator is working their way through to do it for us.
I think the art might be actually shifting to what we were speaking about before. I think the art is going to be The artist will be the person who can tease out of the client the things that they don't necessarily know themselves about their objectives in their situation. The artist will be the person who listens better, who asks the better questions. They'll come up with the better plan because they have more data points to feed into it.
I think that could well be the right argument. I think there are enough algorithms in the suitability process, in the capacity calculations, in our understanding of composure, looking at past behaviour, for systems to inform the final decision. Final decision will be a portfolio, an insurance, an estate plan. And but how you help people articulate their values, prioritize those values, compare and contrast those with those of their partners, and what they did last time they talked about it, will be the art of financial planning. It may, of course, just be an elite profession because of the time demand to do that, the time for reflection. The other parts will be subject to technology. I don't lack any confidence that we can build appropriate algorithms. What we can't do is deal with the fundamental trade-offs a client might have between risk tolerance, risk required, risk capacity, without engaging those very personal goals and aspirations.
And that's an aspirational note for us to wrap up on. Paul Resnick, thank you for being with us.
Craig Saunders, good to talk with you again.
And folks, thank you for your company for our webinar today. Remember, there's a lot of resources on the Financial Suitability Forum for you to work your way through. We have blogs, we have podcasts, we have other webinars, and of course, all the regulations that we've spoken about today. You'll find details there and links to where you'll find all the source documents for that as well. So thanks for your company. We'll see you again soon for another webinar. Goodbye for now.